Hey folks, Jed Bratt here, the Real Estate Jedi of Big Block Realty. And in this video, we're going to talk about the San Diego County real estate market update as it pertains to November 2018. We're going to talk about some historic numbers, current numbers, new graphs, and also some financial news that might give us some kind of cues as to where we might be headed in the coming months and year going into 2019. And of course, if you haven't already done so, please be sure to subscribe to the Real Estate Jedi YouTube channel. And when you do so, check the little bell symbol on the right to make sure you get notified of these videos and other ones in the future as soon as they come out. And of course, if you find value in our videos, we'd appreciate it if you would like and share it with anybody else who you think might also find value in it. Let's go ahead and get started. All right, so we're going to go ahead and get started with active listings. This is active inventory that buyers have their pick from. So at the end of November 2018, San Diego County across detached homes, all property types for residential real estate and all price ranges had an active listing amount of 7,574 listings. That's an increase of 35.4% year over year from the same time last year. So buyers have 35% more options to pick from. New listings. This is properties that were not, relisted or expired. These are actually new listings. So the amount of new listings coming on the market this time around is 8.9% higher than the same time last year. That is going to directly contribute to active listings. And then, of course, pending sales, since these are down 11.9% year over year. These are properties going under contract. 11.9% down decrease is, of course, going to contribute to the amount of properties sitting on the market. And then sold listings is down 19.3%. So, of course, the more new listings you have, if you have the same or less amount of buyers, and then the fewer properties you have going under contract, is going to equate to less sold listings, which of course is going to be reflected in the number of active listings here. So 19.3% decrease in sold listings year over year. And that's also going to be, of course, reflected in the actual months of inventory. So 2.6 months of inventory is where we currently are sitting across San Diego County. That is a 44.4 increase in the amount of active inventory year over year. And you can see active market time has gone up a bit as well, almost 10%. And the sales price, if we were to look at this, the median sales price across the county as well is only up 1.5% from this time last year. Now, this is a monthly statistic, and it's going to be a bit more variable. So if we were to do a rolling 3 months, it's going to be higher. If we do rolling 6 months, it's going to be a little bit higher. But nonetheless, this is just showing us that out of, if we look at this, 2,273 sales, the median price is only 1.5% higher than the same time last year. And that's an interesting thing to see. So it's certainly indicative that the market is slowing. It is shifting more in favor of buyers as opposed to sellers. There are still certainly neighborhoods and pockets where you are seeing very, very high demand for certain types of properties. And then there's other areas that you're seeing are getting hit much harder than others, and inventory is going up even higher than these numbers that we're seeing here. And of course, that's leading to much more aggressive negotiations from buyers, which is going to be reflected in the near future in sales prices. Supply and demand, plain and simple. More increase in supply, less buyers, the same amount of buyers. We're going to have eventual pressure downward on prices. And of course, if you also think about it like this, if there's two sellers on the same street, they both have the exact same model match home, and one seller is super motivated, needs to move to the East Coast, and the other seller is just trying to get what they think is market value based on what recent homes have sold for. Well, the seller that's more motivated is going to probably eventually, if not right away, want to demonstrate their motivation level and drop their price. Whether that's a little bit or a lot, who knows? But the bottom line is, if you have two buyers competing, if you have only one buyer competing for that same type of property in that area, and that seller drops it for that, you're essentially going to have a lower comparable when that property sells, which is going to be something that's used by appraisers when appraising the value of properties for sales down the road. So, understand that with increased supply and more motivated sellers, I think in the future we are going to see some areas with some price pressure downward. Let's also take a look real quick at interest rates, because this is directly contributing to this. And as we can see, interest rates are still remaining in the high fours. Whereas the same time last year, we were around almost 1 full point less than we are today. And something to keep in mind is that for every full percentage point, so from a 4% to a 5% interest rate, buyers are essentially, their payment is going up between 10 and 13% each and every month, just based on that 1% increase. So assuming the same sales price, assuming the same loan amount, the buyer's payment is going up between 11 and 13%, just on 1 percentage point increase. So of course, if buyers are, whether or not home prices are reflecting it, buyers feel right now that they're spending almost 10% more, which essentially they are, per month on their payment than they were the same time last year for even the same priced homes. So that's going to sort of help put downward pressure again on prices, especially if this continues to go up. Now, something to keep in mind is the Federal Reserve Chairman Powell just did announce a few days ago that his opinion of the current rates are that they are just below neutral. Previously, up until that point, he was saying that we are far from neutral, meaning neutral would mean that it's neither a negative pressure on the market nor a positive undue stimulus on the market. It's just neutral, unbiased. He was previously saying that we are far from that. We are far below that. We are still receiving stimulus from the government, essentially, due to lower rates. But now he's saying that it's almost neutral. So that's going to be a bit of a stimulus for buyers in hopes that they will not continue to raise rates at the rate we've been seeing in 2018. Now, up until this point, the expectation has still been that they will raise rates again in December and then yet again in 2019, up to 3 or 4 more additional times. Typically, each time they're looking around 25 basis points, so about 1/4 of a point. So if they do not raise rates that much next year, I think some buyers are going to, hopefully gain a bit more confidence moving forward and not be so worried about rates going up to, unaffordable ranges. And really, historically speaking, if we were really to stretch this thing out, we are doing just fine in the big picture of things as far as where interest rates lie. So even if we were to go up to 5.5%, we're still well within the historical norm. Another thing to draw your attention to is the yield curve for federal bonds, for Treasury bonds, just recently somewhat inverted, not a complete invert, but what happened is the 3-year rate versus the 5-year rate, the 3-year rate's actually higher. And what this essentially is imagine this as a voting system per se, because as more investors are looking at buying more, let's say 5-year note bonds, then they are going to, this interest rate will effectively go down. With increased demand, the return on that is going to go down. And of course, with less demand for something, the rate of return will actually go up. So to see that a 3-year is 1 basis point lower than a 5-year is somewhat interesting because historically speaking, prior to every recession, there is an inversion of the yield curve. And for whatever reason, I can't plot this on the graph as it normally would load up, but what you would normally see is an upward sloping curve indicating that, in the long term, buyers are going to receive more for their money because most buyers don't want to lock up their money for 30 full years. But nonetheless, if you have a 3-year that's selling for higher than a 5-year, this is essentially saying that more demand is being placed on the 5-year bond than on the 3-year bond, basically saying that investors are more confident that their money will be safer with this lower return in 5 years than it would be in 3 years. So essentially, this is not the official spread that normally draws the attention of an inversion on the yield curve. That is typically between the 2-year and the 10-year. But as you can see here, even the 2-year and the 10-year is only 13 basis points away. So this is not that far from each other. So when that happens, I think that will be much more headline news as opposed to right now. It's not really so much a headline news story, but it is interesting to note that the 3-year is actually trading less than the 5-year, and this is certainly becoming a much flatter curve than it has been over the last several years. And again, historically speaking, over the last several decades, every recession has been preceded by an inversion of the yield curve, essentially the 2-year note going for the same or less than the 10-year, actually less than the 10-year. So that's something to keep in mind. If you haven't already, be sure to like and share this video. And of course, be sure to subscribe to the Real Estate Jedi YouTube channel. Thanks for watching as always. And if you found value in this, please share. And I look forward to seeing you in the next video.